I started looking in the brain because I was interested in emotion, and I was convinced there must be something in there that could give us a handle on emotion.
Psychologist Brian Knudsen wants to know how emotions affect one of the oldest parts of our brain that evolved so long ago we share it with many creatures, even lizards.
In general, the lower the area of the brain, the farther back it goes in evolution, right? So we humans still have these subcortical areas deep in the brain. They're ancient.
This part of the brain is called the nucleus accumbens, and it gets triggered by the most primal human needs.
From the standpoint of survival, it makes a lot of sense that natural rewards like food and sex and so forth would activate this circuit that makes you go out and get those rewards.
This part of the brain plays a crucial role in drug addiction. Out of curiosity, Knudsen tries to find things that excite it as much as the prospect of sex and drugs. So he asks people to imagine they are about to receive some money.
Once we started using money, we found very reliable activation in these emotional circuits. This suggests that it's not just sex, it's not just drugs, it's not just food that activates these circuits. Money also activates these circuits, and it does so very powerfully.
Could the fact that an ancient part of our brain gets excited by money explain some of the frenzied behavior by financial traders and consumers during the housing boom?
Hi, welcome to this video today, which is all about Forex psychology. And what I really want to do is look at the general psychology of crowds and how they react in Forex markets, as well as the dangers of emotion and how to control your emotions. Now, from that short video clip, you can see how emotive Forex trading is. It's the oldest part of our brain that basically responds emotionally to money. So it's up there with the basic human drives of, let's say, sex and also food, okay? Now, many traders do not really understand the impact that emotions are going to have on them, and they're not prepared for how emotional Forex trading can be if a trader lets it be. Now, let me just give you an example of how people act irrationally in other areas, okay? And let's take sex, for example. When you were younger, do you actually remember pursuing a woman or a man who you knew really wasn't interested in you, but you still made the effort, even though you knew you weren't going to have any success? I'm sure many people have done that. Now, take diet. Everyone knows a diet can be done, and you can lose weight. But how many people can stick to a diet? It's not very many. I think it's about 10% actually can stick to a diet and lose weight. And in Forex trading, it's only about 10% that win. So the impact of emotion on trading is absolutely huge. And most traders do not behave rationally when it comes to money. It's now seen, obviously, over time, money is a basic need, or seen as a basic need by everyone really. And this is why it causes such problems in trading. Now, when you look at the markets, there's a perception that the markets have become more sophisticated over time. You've got computers, you've got better news, etc, etc, etc. But it hasn't really made any difference to the number of winners, okay? And it never will, because emotions will always dictate how the majority of traders trade. Most traders come in, they know they shouldn't let their emotions get involved, and yet they do, and they act irrationally in the markets. Now, in terms of being irrational, what I want to do here is just show you another clip. And the first one is of an auction of a $20 bill, okay? So the people can bid what they want. And the rules of the game are, it's the person who comes second has to pay the auctioneer. Now, when you look at this video, You might think it is totally irrational what these guys do, but watch the video afterwards as well, where it's done in the real world. It's really interesting, in terms of understanding human psychology and an introduction really to the psychology of crowds. So what we're going to do is just quickly look at this clip and then we're going to discuss it.
We're going to start off with a game.
Take the auction of the $20 bill that's sold for $28.
$1. $1. How about two? Two.
In the rational model, a person should never pay $28 for a $20 bill.
5 in the back. How about 6? 6.
Paying more than something is worth cannot be in anyone's best financial interest.
9.
The auction is a key experiment for behavioral economists.
12.
It's designed to be a trap, and it's a trap that if you don't think more than a couple steps ahead, you fall into.
11.
12.
It's the emotional desire to win that drives bids up,
14. 15. Do I hear 20?
and the fear of being the loser that drives them even higher.
23. 24. 25.
And now it's a game of chicken.
27.
27 go once. 28. 28. $20 sold for $28 to this gentleman. And you owe me $27 as well. So I will
Nobody will want to play that game twice.
The auction may seem far removed from everyday life, but do people outside of the classroom behave just as irrationally? We asked shoppers in a Chicago mall if they would prefer $100 in a year's time or $102 in a year and a day.
I'll take the $102 in a year and 1 day.
$102.
Year plus a day.
And then I can wait that extra day for the $102.
For extra $2.
Yeah.
It really won't make me a difference.
I would do the 102 a year and a day from today.
They all made the rational decision
What's 1 day after a whole year of waiting?
and chose the larger amount. Then they were asked if they would prefer $100 today or $102 tomorrow. The larger amount is still the rational choice. So what did they say?
Oh, I'll take the $100 right now.
I would take $100 today.
I would prefer the $100 today.
Today.
I'm taking $100 today.
The desire for a quick reward
$100 today.
trumps their rational self-interest.
There's something called present bias, that if we have the option of something right now, it's very tempting to go for it.
I will come back after those two short clips. The first clip showing people paying over the odds for a $20 bill. And while it might seem extraordinary to many people, if you look at the Forex markets, paying over the odds basically happens all the time. Prices get pushed too far from fair value. The news says the price is going to continue forever. People just want to get in and get a bit of the action, get a bit of the profit, and they don't understand true value. Their emotions are involved, greed, it blinds them to reality, and at the important market tops, speculators are always caught heavily long, and they're heavily short at market bottoms, those important turning points. In that second clip, you can see actually how important money is to people in terms of greed. Okay, when it's a long way away, rational thinking is there. When it's very, very close, they want it now. This happens in the Forex markets with traders as well. As soon as they open an account, they want to trade. They will hunt out opportunities to trade. Adrenaline is running. Emotions are to the fore. They're greedy. They want money now. And you'll see it all the time with traders. They overtrade, they take low odds trades, and they lose. If you want to win in the Forex markets, you've got to understand when prices have spiked too far and learn how to take advantage of that, and we'll look at that in a moment. And also, one of the best bits of advice a trader can take from anyone is be patient. Don't just look to trade any setup. Wait for the very best setups, the highest odds to come around with your trading strategy. And just make sure you trade less. I see a lot of people who come into Forex markets, they just trade on whims or tips or you know, what their friend might be doing. It's ridiculous. Yeah, it's a serious game. You will never ever make money if you trade too much. And you know, it's one of those things. You can tell traders not to trade too much, but they will continually hunt out what they consider are opportunities. But if they thought about it rationally, the odds would not be in their favour. Now, I've just basically just gone through how irrational, you know, traders are when it comes to money, and now I want to go on to looking at crowd psychology. Now, crowds in Forex markets become a very powerful force, but they're a very destructive force. And if you look at any market, you'll find that the crowd actually starts to trade it without thinking about fundamental fair value, and they push prices too far to the upside, too far to the downside. This will never ever change, and it offers an absolutely fantastic opportunity for the disciplined trader who can judge value and to make money from mass crowd hysteria. Now, what I want to do is just to illustrate how a crowd loses its senses, and they all want to be in on the action together. We're obviously a herd animal, so we feel safe in groups. And I want to give you the classic example of a bubble. Okay, now this bubble took place in 16th century Holland, and it's all about speculation in tulips. And you might watch this and you might think, no, we're more sophisticated than that today. But what I'll do is, when this video clip is over, I'll give you an even worse example than speculating in tulips. So let's just take a quick look at this clip, and then we'll look at the psychology of crowds and how to make money from them.
The first financial bubble involves something highly unlikely.
In the 1630s in the Netherlands, people were buying and selling tulip bulbs. Complete mass insanity in Holland for a couple of years there, where hundreds of people, artisans, would leave their workshops and set up business as florists, they call themselves. Even for the most part, what they really were tulip bulb traders. And it was a real financial market.
The price of tulips in Holland rose to such a level that the value of one tulip bulb would sometimes be the same as that of an entire house.
Over a 3-year period, the price of tulip bulbs rose and then began to soar. By some accounts, almost half the money in the Dutch economy was caught up in trades involving tulips.
To a lot of historians, this is really the first example of a financial bubble, even though it was basically tulips.
People were buying them not primarily because they liked tulips, but they were buying them because they thought that the price was going up and they could resell them to someone else at a higher price.
On February 5th, 1637, the most expensive bulb in Holland failed to sell, and tulip investors panicked.
Then it burst, because prices start falling, and then they're falling more, and then you start thinking, you know, I remembered, I doubted that tulips could possibly be worth so much. Maybe I better get out fast. And then everyone starts dumping, and then it just drops.
As the prices plunged, leading citizens found themselves bankrupt.
Now, welcome back after that short clip about the tulip mania back in 17th century Holland. We are no more sophisticated today. The crowd psychology that pushed tulips to unrealistic levels is still doing it in markets today, and always will. If you want a worse example of the tulip mania that's happening today, in my view, take a look at Bitcoin. I think someone actually said in the media, I thought it was totally correct, I can't remember who said it. He said, at least in the tulip mania, you got a tulip. What is Bitcoin? It's just a crowd psychology driving a price of nothing. It'll end in tears, okay? But Bitcoin aside, we can see loads of booms and busts. 1929 crash, 1987 crash. Booms and busts are always occurring in financial assets, and they occur in the currency markets. We may have lots of computers today, instant communications, lots of news. All those tools actually do not change the fundamental fact that markets are controlled by human psychology, and when humans basically trade markets, they respond to greed and fear, and when they get in a herd, they basically push the price to unrealistic levels. As the price goes up, everyone wants to get in on the action, and traders just don't think that prices have been pushed too far. And then, of course, it ends in tears. Now, as a Forex trader, trading contrary is a fantastic way to trade the markets. And I've done several videos on this, but I'm just going to briefly through the way to trade price spikes. What you want to do is look for a price spike on the charts, then look at the news. Look how bullish everyone is. If you've got people saying there looks to be no end in sight to this move, or the currency is going to go to some price way ahead of the current price, chances are it will not. You're probably getting to a bullish extreme and prices are going to break. So how do you measure a bullish extreme? Well, just get out a chart. Obviously your price action, but you can't really see from price action how overbought a market is historically. I'm all in favour of using indicators to measure the actual bullish extreme of the market. You could do it with a volatility indicator like the Bollinger Band, combined with momentum indicators like the stochastic, MACD, ADX, etc. Doesn't matter which ones you use, just make sure that the currency pair you're looking at is at an overbought extreme, not just overbought. Then all you do is you wait and you sell divergence. And when you're trading turning points, you can trade with very tight stops. It doesn't matter if you're wrong a couple of times and get stopped out. You can come back, and you can't measure exactly when a market's going to break, so you might have to have a couple of goes at it. But once you get in the move, it's likely to be a big one as greed goes to fear. So I've always found at turning points, might lose a couple of times, third time probably catch it, and I'll make a lot more on that winning trade than I lost on the losers. And you're going to get a big move, because greed, basically when it peaks, you get the smart money exit first and the price stalls, then it starts to drop, and then everyone tries to get out at once. Being a contrary trader is a great way to trade the markets, and you're taking advantage of crowd psychology, which never ever changes. If you can be cool, calm and logical and look at the chart and basically wait for divergence on these big price spikes, they never last, you can then get a great move, normally back to a mean price, and profit while the crowd loses. I've always said that if you can trade with discipline and keep your emotions in check, all you need is a simple strategy to make money, and that will never ever change. Anyone can learn that simple strategy, and trading with discipline is really a choice. You just have to understand the impact of emotions, keep them under control, and have a simple strategy you've got confidence in, and you can make a lot of money trading Forex. So hope you enjoyed this video, which is a brief introduction to crowd psychology really, but you can see how effective trading against the crowd can be and how lucrative it can be as well. So thank you very much for watching me. Take care. Have a good day.